But we've got a management waiting by to chat with us. Happiest Minds Technology, that's the mid-cap IT company on our radar. The dollar revenue growth has been modest at 2.1% on a sequential basis. Profits and margins slightly muted. We're now joined by the company's Managing Director, CFO Venkatraman Narayanan, and the Executive Vice Chairman and CEO of Product Engineering Services, Joseph Anantharaju. Gentlemen, thank you very much for joining in. Venkat, first question is, your revenue growth at 2.1% is the slowest that we've seen in the last couple of quarters. In the past, you've recorded higher revenue growths. Could you tell us the reason for that? Was it higher furloughs, any one-off impact? Anything which impacted your top line, and what could you guide for Q4?
Yeah. So if you look at it, our constant currency growth has been about 2.8%, Sonia. And you're right, compared to the earlier quarters, it's slightly lower than the 5% that we have had until now. The reason for that has been, we had one lesser number of billing day, and also there has been an increase in the holidays taken by people. So if you adjust for these two, we are back to the 5% plus. But the larger picture is YTD 9 months, we have done 26% growth year over year. And on the profit front, we are at 26% compared to the guidance of 22 to 24%. So both on the revenue front and the profit front, we are ahead of the margins that we had guided for the year.
Okay, ahead of the margins. Joseph, are you seeing any kind of slowdown in terms of growth or any delays in client spending, any delays in decision making?
Not really, Sonia. The period after November and Q3 typically tends to be one where customers start easing up, and that's a seasonal thing that we've seen in the past as well. But outside of that, we've not seen any slowing down. And in fact, our pipeline at the end of Q3 continues to be strong. And in the first 2 weeks of this year and the quarter, we've already had a couple of large deal closures. What we're seeing is that customers are prioritizing digital initiatives that have either a strategic benefit in terms of differentiation or helping them with some major benefit in the mid to long term, or projects and initiatives that will give them immediate and quick revenue. So those are getting prioritized right now. That's one trend that we're seeing. The other that we're seeing is that customers, the CFOs, are not releasing the entire year's budget. They're breaking it up into quarterly budgets and giving it to the budget owners, so that there is the usual case of cost getting front-loaded and revenue back-loaded. They're trying to address that issue as well to make sure that there's flexibility in the way they operate.
Okay, got that. Joseph, since we were talking about growth, I think the revenue decline has perhaps been sharpest in the BFSI space. It's down around 26% versus last quarter. Can you tell us what's going on, and do you expect the pressure on this vertical to continue?
So there are two reasons, actually. The first one is there was one customer who could have been classified either as a health insurance company. Earlier, it was classified as insurance. We moved it into the healthcare space, which will start reflecting as a vertical from next quarter onwards. So that had a pretty large impact. And so you see the other revenues has gone up significantly because we moved it over there. The second is there are a couple of accounts where we had one-time revenues in Q2, which didn't get repeated in Q3. And those have primarily caused the drop quarter-on-quarter basis in the BFSI vertical.
Got it. Venkat, coming back to the point that you made at the beginning, that if I adjust the Q3 performance for revenues for the holidays, the lesser working days, then the growth rate would be similar to what you have clocked in the past, which is closer to 5%. So in Q4, can we expect the company to clock in the historical growth rates of 5%?
We are hoping to do that, Sonia. But the larger point is we are tracking to meet the 25% guidance on revenues for the year. So yes, the hope is that we want to meet the 5% plus number in Q4. But the base keeps increasing, so there will be slight adjustments that one needs to make for that. But largely, it's aligned to the 25% growth for the year.
Okay. So
And we are gunning for it, and we are hopeful of that.
okay. So this 25% growth is despite the kind of decline that you've seen in BFSI, right? I mean, you're not expecting any
That's
further
right.
fall in BFSI, which could
That's
hit
right.
growth.
Yeah, we had Joseph talked about the reclassification that we did. Despite that, and the furloughs and the holidays that we had, which was kind of unplanned for in Q3, we hope to cover that up in Q4 and also meet the numbers of 25% for the year, and
Okay. What about
maybe even beat that.
Sure. Joseph, what about attrition? I think it was about 20.9% in Q3.
Yes.
Do you expect it to fall?
Yeah, if you see, during the quarter, it fell almost by 3 to 4%, and we're seeing the market becoming a little bit more balanced now between demand and supply. And given the initial trends that we are seeing in terms of resignations in December and November and the early part of January, I think this number will continue dropping. And over a couple of quarters, we should get back to our historical numbers of between 13 to 16, 17% attrition, and that will also help a little bit from an operational perspective.
All right, got it. Gentlemen, we're going to leave it at that today. Thank you very much for joining us and taking us through the outlook for Happiest Minds. So that is the management telling us that, things are likely to pick up maybe in the next quarter on the revenue front. They could see 5%. But Rima, interesting, right? They said that the budgets are coming in quarter by quarter instead of all at one go. So that's perhaps telling in a way.
It is, because it does indicate that the clients are also uncertain. So typically in January, you would release that I'm spending 100 rupees on my tech budget. But now companies are saying, I'm going to spend 25 rupees for the first quarter.
Then we'll see.
I will reassess based on the situation. If the client's financials are going to deteriorate in the Jan to March period, who knows, right? The next quarter's budget may be even lower, right? So that uncertainty remains.
Caution is there,
but all the other tech companies that we had chatted with over the last 2 quarters did indicate that tech budgets are not fully finalized yet, and we will get greater clarity only perhaps in the month of February. But need to get into a break?
Yes, let's take a quick break. We'll get you more on the markets on the other side.